Welcome to ICAN Intelligence. We're here to build a deep, exam-focused understanding of the IAS standards, starting right from first principles. Today, we're diving into IAS 32, Financial Instruments Presentation. Let's get started. Okay, let's jump right in. At the heart of IAS 32 is one massive question that every single company has to answer when it raises money. Is the money they just raised a form of debt, or is it equity? Is it a liability, or is it ownership? Now, don't just think of this as some tick-box exercise for accountants. No way. This single decision, it changes everything. It has a huge impact on a company's gearing, its risk profile, and ultimately how investors and the market value the entire business. Getting this right isn't just important, it's absolutely critical. So here's our game plan. We're going to start with the why, the fundamental reason that this standard exists. Then we'll lock down the essential definitions. After that, we'll hit the core principle of distinguishing liabilities from equity before tackling the trickier stuff like compound instruments and offsetting. Let's do this. Okay, first things first, let's zoom out. Why do we even need this standard? What's the core problem IAS 32 is trying to solve? Well, the whole point, and this is straight from the text of the standard, is to create a level playing field. It's all about consistency and clarity. The goal is to make sure companies can't get creative and dress up a loan to look like equity just to make their balance sheets look healthier. IAS 32 is the rulebook that keeps everyone honest. All right, before we can even think about classifying anything, we have to get the language right. We have to know the vocabulary. And I'm telling you, this is the bedrock. In an exam, this is where easy marks are won or lost. So let's nail these definitions down. So look closely at this definition. A couple of things should jump out at you. First, it's a contract. That means there's a binding agreement. And second, notice how it creates this perfect mirror image. One company gets a financial asset, and the other gets either a liability or an equity instrument. Two sides of the same coin. So what are we talking about when we say financial asset? Well, the most obvious one is cash, of course. But think bigger. It's also things like your trade receivables, which is just a fancy way of saying you have a contractual right to get paid by a customer. Or maybe it's shares you've bought in another company. All of those are financial assets. Now, flip the coin. Here's the other side, the financial liability. And listen, if there's one phrase you need to tattoo on your brain from today's session, it's this: contractual obligation. This means the company has no choice. It has to pay. A bank loan, a bond you've issued, those are classic examples. There's an unavoidable obligation to hand over cash. Okay, so if a liability is this unavoidable promise to pay, then what on earth is equity? The best way to think about it is, it's the leftovers. It's what remains, the residual interest, in the company's assets after you've paid off everything you owe. Equity holders are owners. They get what's left. That's the crucial difference. All right, pay close attention now, because what we're about to get into, this is the beating heart of IAS 32. This is the whole ballgame. If you get this, you get the standard. And trust me, this is what the examiner will test you on. And this table just lays it out so perfectly. On one side, you have the liability, a contractual obligation. The holder has a claim on you. You have to make mandatory payments, like interest. On the other side, you have equity, a residual interest. The holder is an owner with you, and payments, like dividends, are completely at the company's discretion. Obligation versus ownership. That's the core distinction. And this brings us to the absolute golden rule of IAS 32. You need to write this down: substance over legal form. It does not matter what the instrument is called. It could be called a preference share or a fluffy pink bunny. We don't care about the name. We care about the substance. What does the contract actually make the company do? And here it is. This is the #1 trap I see students fall into in the exam hall. The examiner will throw a redeemable preference share at you. You see share and you think, equity, wrong. If the terms say the company must redeem those shares for cash at a future date, then there's a contractual obligation. And what does that make it? A financial liability. You have to read the terms. The substance is all that matters. Okay, so we've got the basics down. Now let's level up. Let's talk about the tricky stuff, the kind of thing examiners absolutely love to put on the paper: compound instruments. This is when a single instrument, like a convertible bond, has a little bit of both liability and equity mixed in.
So IAS 32 tells us we have to do something called split accounting. It sounds complicated, but it's just a logical process. Step 1, you take the total cash you got for issuing the bond. Step 2, and this is the crucial part, you figure out the value of the liability part first. You basically calculate what the bond would be worth if it didn't have the conversion option. Step 3, the equity component is simply the leftover amount. It's the residual. We always deal with the liability first.
So why do we go through all that trouble? Well, here's why it matters. That interest on the liability portion, that's an expense. It hits your profit and loss account and reduces your reported profit. But any dividends, that's totally different. That's a distribution of profits, an appropriation of equity. It never touches the P&L. Two completely different accounting treatments flowing from one single instrument. Okay, let's shift gears to another area that pops up on exams all the time: offsetting. So here's the scenario. Your company has a receivable from customer A, but you also have a payable to customer A. Can you just net them off and show the one smaller number on your balance sheet? When you see an offsetting question in an exam, what's the first thing that should pop into your head? The answer is almost never. Seriously, IAS 32 is incredibly strict about this. The default answer, your starting point, should always be no. You can't offset. You can only do it if you meet two very tough conditions. And you see, it's not enough to meet one of these. You have to meet both at the same time without exception. First, you need a legally bulletproof right to do it today, not at some point in the future. And second, you have to actually plan on settling it that way. If either of those conditions isn't met, you're out of luck. No offsetting allowed. The asset and liability must be shown separately.
Okay, we've covered a lot of ground. So the crucial question is, how do we take all these pieces and build a simple, powerful framework you can use to nail any IAS 32 question that comes your way?
Think of this as your exam day checklist. Just walk through it step by step. Number 1, is it even a financial instrument? Check your definitions. Number 2, look for those magic words. Contractual obligation to deliver cash. That's the key. If the answer is yes, it's a liability. If it's no, it's equity. If it's a bit of both, you know you've got a compound instrument and you need to do your split accounting. And last, you ask about offsetting, remembering those two strict rules. Follow this and you can't go wrong. And that brings us back to the big why. Why does substance over form matter so much? It's about truth. It's about ensuring the financial statements aren't a work of fiction. By forcing companies to report the economic reality of their financing, IAS 32 protects everyone, investors, lenders, employees, who relies on that information to make good decisions. Thank you for joining this ICAN Intelligence Masterclass. If this helped you, please hit that like button, subscribe, and let me know in the comments which IAS standard you want us to tackle next.